So it's the end of the
I'm
week. It's Friday. It's a good opportunity for us to take a look at kind of a midday summary of what's going on in the markets. We've been in a pretty strong rising pattern for the last 12, 13 days. And it's interesting to me, despite the fact that I've got a couple positions that are underwater, that the market has moved against, it's always interesting to me to look at purely a non-emotional technical charting view. And I like to always start with Abel trend, the short-term time frames. And short-term for Michael and myself is the 3 9-minute chart on each of our three indexes that we trade, and the 5 15-minute chart on each of those same indexes. So what I've noticed here, Michael, is that NDX on the 3 9-minute chart has shifted into a double stack declining pattern, right? Double stack to the
yeah,
downside.
yes, sir. The 9 minute, large 9 minute dots and the small 3 minute. Yes.
And what's significant about this pattern is, by the way, I like these types of patterns. What's significant is exactly what you just outlined, is the 9-minute and the 3-minute resistance levels are what we call stair-stepping lower. It's like walking down a staircase. And as they stair-step lower, my interpretation of that is that that's strengthening the cycle, strengthening that particular cycle to the downside right now. There is additional validation of that as a good downside cycle to trade. So if you've been a conservative trader, and we've talked a lot about being conservative when you're trading, and it's entirely up to you how aggressive or conservative you want to be. But if you are a conservative trader, you might have watched this pattern develop and you're not exactly sure when to get in. Well, now you've got confirmation of the pattern based on the 3 9-minute. It's stair stepping lower or double stacked to the downside. So when would be a good time to get in, Michael?
Well, just like I did. If we start stair stepping to the downside, more than likely we're going to pull back up off this Bollinger Band and get back to the sweet spot. Sweet spot is when it gets back to the 3 minute dots. I like to have nine and above me also, so we call it being double stacked. But when the bar closes red, when it moves almost up to the
Resistance.
resistance level, I like to go in. But I didn't take this bar right here because it closed in the center half of the bar, and you see it pull back up again. What I like to do is take the bar when it closes at the bottom of the range, and that's the bar I took right there.
And look
Now,
at how that played out for you. Very
yeah,
nicely.
it played out very nicely. That's exactly right. Sometimes, especially in the volatility we're in now, you can go in early and it's not that big a deal. But I've just over the years, I'm just experienced. I have an able trend. I just like to let it close on the bottom end, and then usually, not every time, but usually it works out pretty well.
So what are the pluses and minuses of waiting until it closes on the bottom end? What are the pluses to doing that?
Well, the pluses are to me, 90%. I'm gonna say it's in the 90% range. I don't have to manage that position. I can make profit on it,
So it's a
and then move on to the
conservative
next.
entry. That's a
Yeah,
that's
it
a
is
most
very
conservative
conservative.
entry that you could use.
Yes.
So the green bar preceding that was trading right at 3-minute resistance. What if you'd entered on that bar?
Well, it would have worked out, but it'd been more risky because it could have reversed and went right back through the 3 minute. Because at that time, these 9 minutes hadn't printed yet, so you wasn't sure what was going on. You just know what's here in front of you. So it'd been more risky because it could have reversed. Could have.
Yeah. So what I really want to emphasize for folks, especially folks who might be new to the live trading room here, or might be listening and have never participated, um, what Michael just demonstrated and explained to you is a conservative entry. You can be more aggressive if you want to. You could have gotten in on that green bar when we pulled right back up to resistance, but there's no certainty that it's going to reverse and head lower. And of course, in Michael's entry, there's no certainty that that trade's going to work out either, but that is a more conservative validation of a continuation of the pattern that has been developed. Now, what's the downside of waiting for that conservative entry? It
Well, you're
really,
going to
yeah, go ahead, Michael.
well, there's two things. You're going to pay more for the option, and no doubt about that. You're going to pay more for it, and then if it did reverse, you've got more of a risk, basically, if to cover the trade because you got more room for it to run back up to the other resistance point. So
So the risk really is you might miss some opportunity
yeah,
because the price has moved, so you might miss opportunity. But missed opportunity is something you ought to set aside as a trader and say that's just part of the game, part of me deciding, placing a calculated trade that I believe is a conservative position. Risk also is then if it does move back up to the sweet spot, up to resistance again, you might be behind on the trade. So there's risk in every type of options trading you will do, but it's it's the degree of risk that you're willing to accept and the amount of capital that you're willing to put into that trade. Now, one of the reasons Michael and I are reasonably comfortable with accepting that risk is we're never going to overextend our capital. We're only going to trade capital that we can afford to risk. And the second thing is we know that if that position starts moving strongly against us, we have a view that it's double stacked to the downside, stair stepping lower, all of those things align saying it's highly likely it's going to continue moving lower. But if it does not, then we have strategies that we teach in our Profit Accelerator programs, fairly simple strategies that you can cover the position pretty quickly. So just as a for instance, if you had uh, purchased a long put and maybe spent $60 on that long put, we will cover that trade if it starts moving against us at a certain level, and we might be able to sell to open put against that for perhaps $55 and essentially take our risk profile from $60 per share down to $5 per share. Now that's a huge difference, and it gives us the luxury then of being able to work both sides of that spread. If we continue moving higher, we might be able to take a profit on the short and then wait for the next down cycle. So the pattern I see right here, I think is just a very perfect example of getting in on the sweet spot, waiting for validation, and knowing that you can cover that if the price were to start to move back above 3-minute resistance. Or you might, again, be a more aggressive trader and you might wait until it moves back up to 9-minute resistance. And if it starts moving above that, then you definitely would want to cover that trade. So when you look at the 3.9 on NDX, Michael, and then you compare it to the 5.15, what's the picture you see there?
well, we're both double stacked to the downside. I mean, it looks like to me we're going to go lower eventually.
So you know how yesterday we talked about the things were inconsistent between time periods and the indexes?
Yes.
Here we're seeing an example of a consistency between the two time periods. That's the 3.9 and the 5.15. Those are the time periods that we use primarily to trigger entry into a new position. And I like that. They're both double stacked to the downside. They're both stair stepping lower. On the 3.9, both the 3 and 9-minute resistance is stair stepping lower. On the 5.15, just the 5 is stair stepping lower, but we are starting to print 15-minute resistance also. So just real quickly, without as much detail, we're seeing the same thing on SPX. The 3.9 and the 5.15 are consistent between time periods, which is
Yeah.
one of the first things I look for if I want to take a conservative trade. If you see a signal on the 3.9 SPX, but 5.15 is contradicting that signal, will you take that 3.9 signal?
And I want Mark. No, not conservative point. No, I'd like to see them all lined up the same, just like you said.
And so right now, if you saw SPX move back up to 5-minute resistance and the bar turned red and closed red, that looks like it might be a good entry.
That'll be a great entry, I think. As long as the 3 minute stays where it's at and it comes back with it, and the 3 minute prints, Yeah, and it just printed, so I would be definitely looking at that.
Okay, so let's shift gears and let's look at RUT because it's a very different picture on RUT.
Yes.
Now we've stair stepped lower on 3 minute resistance, but and we're trading right at 3 minute resistance. But why would you not take that trade?
Because we got support underneath. It's printing the 12 at 12:03. The 9-minute blue support level is still continuing to print.
So we're tucked in a very tight range between 3 minute resistance and 9 minute support.
Very tight.
And then what about the 515? Any different picture?
It, it's the same. It's still got some 15-minute support, but the range is a little wider. That's all. But I still wouldn't take it there because of that.
So NDX and SPX are looking like good possible trades,
Yes.
sweet spot trades. And I know you already did one today. What was the profit that you took on that one per share? Took it
$2 per share.
$2. So is $2 kind of a sweet spot for you of taking a profit?
It is. It is, Mark. Yes. That's what
Why
I
would
said.
you hold out for more?
I can guarantee myself $2. That's why it can reverse on me, and I like to make base hits.
So
$2 here, $2 there.
yeah, base hits. That's the term that we use in the live trading room. If you take profits frequently and recycle the capital, you're generally going to do better overall than you will if you're always holding out for more on that single trade.
Now, and Mark, to be transparent, if I'm in a good trend, but I hadn't seen a good trend lately. It's just real choppy and bouncy. So that's another reason I like to take the $2 quick. So because I don't mind holding a position as long as I've got a good trend down. We've seen trends down where these things start stacking, stair stepping down, really, really nice, and then you can just continue to do that. But anyway, but just
And that's a good point. So I think if I take that and emphasize what you're saying, it's important to be aware of what the your macro view of the market is. We've been in a very choppy, flat, difficult to trade pattern for several days. And although the market had trended higher, strongly higher for about 10 to 12 days, we've been in a pretty tight range here recently. So if you can harvest a profit of $2, and that means also it's not just the profit, but you're taking all of your risk capital back and it's back in cash, so there's no more risk. It's an excellent way to be successful at day trading. Now, if someone doesn't want to day trade or their account doesn't allow them to day trade, they don't need to be restricted from taking these types of trades. In the case of the trade that Michael took, where he locked in a profit by day trading, took $2 a profit, for someone who doesn't want to day trade, you can buy to open that same put that Michael bought, or a different put. You might go deeper in the money, or you might go at the money or out of the money. Part of that's going to be dependent on how much capital you're willing to put at risk. But instead of selling to close that position within the same day, we're going to show you how to sell to open a strike against that and basically create a spread for yourself that has a favorable price. And more than likely, you can close out of that spread then the following day to take your profit. So your profit may come a day later, but you avoid the day trading, but you can still participate in taking these signals. Michael likes to go deep in the money and may spend more on an individual trade than some of you would want to, but that doesn't mean that that strike that Michael chooses is the only strike you can trade. Michael might go 50 points in the money on NDX. You might decide that you don't want to spend that much and you want to trade at the money. And you're going to pay significantly less to participate in that trade. Someone else might decide to go out of the money and pay even less. Now, there are varying degrees of deltas that you're going to experience in those decisions. But the point here is that this type of trading, starting with a foundation of Able Trend, the 3-9 and 5-15 charts, the same signal can be used to trade any size account. And it doesn't matter whether you can day trade or not day trade. you can still take the same signals, and from there, the variable is how you're going to execute either the cover and creation of a spread, or hold the position till the next day, which we don't advise, especially if you're just starting out, unless you know exactly what you're doing and have eyes wide open to the risk of holding overnight. But there are ways that you can create a spread. You can leg into the spread and basically lock in for yourself an opportunity for the same or more profit than what Michael was able to take on his day trade. So in terms of the macro view, let's come over to my bar charts, and I want to show what's been developing since yesterday, since we talked about those patterns.
And also, Mark, while you're switching over, there was a client that followed me along just on that trade just a bit ago that I made, and he was not as deep as I was. I mean, he was, I think, only 25 points in the money. He actually legged in for $1.20 credit on that position, so it worked the same as me the day trade I made, but he legged in. He'll get his profit on Monday, but he
There
still
you
legged
go.
in for $1.20 credit, which is great.
See, the the same signals. Use Able Trend as the foundation for your entry, and then learn the variables of how to lock in a profit that are appropriate for your account. Appropriate risk, appropriate day trade or not day trade, appropriate holding time period. All of those variables can be adjusted to your individual account. We actually talked quite a bit about that in session 3 of the Profit Accelerator course, how to modify the strategy to accommodate your own personal risk tolerance as well as the size of your account. So I usually start with NDX, but I'm going to start with RUT today, and I'm going to go through RUT, SPX, and then I'm going to finish up with NDX, because on NDX I want to emphasize what we were seeing yesterday versus what we're seeing today. So first thing is I'm on a 30-day, 30-minute chart on RUT, and the thing I want to point out to you here is that since the 8th of July, RUT has been basically in a flat to steeply declining Twin Peaks pattern on the AO. Now, AO represents momentum, and so we were moving in flat momentum here for a few days, and then we started to decline in momentum. And the reason that's significant to me is because momentum is what drives price and activity. And waning momentum does not necessarily mean that price is going to decline immediately. But if you have weakening momentum over an extended period of time, you can almost guarantee that price is going to follow lower. And that's what we're seeing here on the intraday 30-day, 30-minute chart. RUT has been hinting at us that there is some sort of a decline coming. We even had, if I magnify this, we even had a zero line crossover where we stepped below the zero line, we step back up just slightly above the zero line. We're basically trading flat to the zero line right now, which indicates that there is practically no momentum. And you can see that the tighter we got to the zero line here, the tighter the price range movement became. In fact, let me take off the study so you can see. There you go. Very, very tight trading range here the last 2 to 3 days. And that will generally be the first indication of some sort of a breakout, one way or the other. Now, we could break to the upside, but momentum is telling me that it's more likely that we're going to break to the downside, but there's no guarantee of that. So this is what I'm seeing. And then let me show you the 1 year daily chart. You can see here that we're still trading in a rising cycle that sits inside of a mostly sideways trending channel. We've been trading at resistance of that sideways trending channel for the last 4 days, including today. And you can see this, I find this very interesting. Go back 4 days and look at the size of the bar, the range of high to low. The next day's bar was what's called an inside day where the high was lower than the previous day's high and the low was higher than the previous day's low. So it's an inside day. The entire range was smaller than the previous day's range. Now look at yesterday's range. It was also an inside day, And so far today, we have an inside day. So that's 3 consecutive inside days of trading on RUT. That's another indication, telltale sign that we are consolidating and there will be a breakout of that price activity one way or the other. This by itself does not tell me which direction it's going to break. I need to look at other indications to help me understand that. The 30-day, 30-minute intraday chart is telling me that intraday we're starting to see declining momentum. We have been seeing declining momentum, and we've dropped right down to practically no momentum at the 0 line. The other hint that I have, 2 other hints of possible direction, are all 4 of these daily bars have been trading right along that sideways line of resistance. So that's telling me that we're confirming this sideways line of resistance that was first defined back here September 17th, and then in here around the 1st of November, and then in here around the 1st of December. So we've come right up to that level and we've not moved above it. Does not mean we won't move above it. It just is saying that as of right now, we have not pressed above that. This line of resistance is acting as a pretty strong headwind. The second clue I mentioned is we're coming off of a Bollinger Band snap and we are trading right at the upper 2 standard deviation Bollinger Band. So what does that mean? Well, we could in fact remain in a rising cycle. We could break above this line of resistance. Now that could happen immediately, or as evidenced by 30-day, 30-minute momentum, we could find ourselves dropping back down to support of this rising pattern. So let's just go out, let's say to August 1st. And what if the price by August 1st dropped back down to that rising level of support? That would put the price of RUT down around 1117. Now, don't take that as a tradable pattern. That's not why I'm looking at this. What I'm trying to do is to have a macro view of what's going on this index so that when I'm looking at my short-term charts and I see something that may be double stacked to the downside, I may be willing to take a slightly more aggressive entry on that trade because I know that the macro view is hinting towards downside bias. If I see a buy signal indicated on the short-term trade, I'm not going to be afraid to take that buy signal, but I'm going to probably wait for a very conservative confirmation of that signal because I know we're trading at a long-term line of resistance. We're trading right near the upper Bollinger Bands, and the intraday AO is telling me that momentum is practically non-existent. So that's the way I would use that information. Let's take a look at SPX. Now SPX on the 1-year daily is interesting because much like RUT, we came right up to a mostly sideways line of resistance. This is a slightly upticking line of resistance because it's coming off of the prior highest high, which was 2134.72. Today, sorry, let's see here, just double check here. Today we hit a high of 2169.05. Yesterday it was 2168.98. So today we hit another new all-time high on SPX. But those highs are very close to each other, which tells me that at least as of right now, we have pretty much stalled out at that line of resistance. And the other thing is with today's high being higher than yesterday's high and the current price is trading at the bottom of today's range, we are right now forming a bearish divergent bar. So when you have a bearish divergent bar form at a long-term line of resistance near the upper Bollinger Band, those are 3 things that are consistent, and the consistency is pointing to a potential reversal in the current rising cycle. Now we've been in this rising cycle for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days. This is day 13 of our rising cycle. That is another point in favor of a potential decline because eventually a rising cycle will exhaust and there will be formed a declining cycle. We also have a oops pattern to satisfy where the price needs to trade back down to the high that formed on 628, because the next day of trading 629 there was a gap forming that oops pattern, and that means we would need to trade back down to around 2036 to satisfy that oops. So we've got weights that are hanging on SPX right now. SPX may actually have enough strength and energy to move to the upside above this long-term line of resistance, above the Bollinger Bands, or press the Bollinger Bands further out. May have enough momentum and strength to continue to fight against that oops pattern. We won't know that until all that happens. But my takeaway from SPX right now is that if I see a signal to go short on SPX, I'm probably going to feel confident taking that and may even be a little more aggressive in terms of my entry. If I see a signal to go long on SPX, it's not that I won't take that signal, but I'm going to wait for a very conservative confirmation of the signals before I take that trade. Let me go to the same 30-minute view that we did on RUT, and let's look at the AO. See, right here you can see that since around the 8th of July, we've been in a declining Twin Peaks pattern. That means we've had short periods of rising momentum. We've had short periods of declining momentum. But as we shift and transition from increasing to decreasing momentum, those peaks, what we call that transition from green to red, have been getting smaller, which is an indication of overall declining momentum. During the same period of time, we've had overall rising price, and so that creates this divergence between rising price, declining momentum, and eventually that rubber band will snap and pull price back lower. Now, I want to go back to daily here just for a minute before I jump to NDX, and I'm going to take the studies off, and I want to just do a couple of quick evaluations here. So if SPX did in fact move lower, where could it potentially move to? Well, number one, if we just simply do a Fibonacci retracement pattern, coming off of the low, the last low before this rising pattern started, and hitting the high, the highest high, which occurred today, a simple 50% retracement would take the price down to 2080. A 38% retracement would take the price down to around 2100. So those retracements are reasonable levels of retracement before the index may continue moving higher. If we actually broke through both of those retracement levels, including the 62% retracement, which would be 2058, which is interesting, that'd be 100 points below where we're currently trading. Well, if we broke below that 62% retracement, then that may indicate that we're in for more of a significant decline. But if we came down to the 38 or the 50% retracement level and then turned and headed higher, that may be the pause that we so frequently get in these indexes, because we always get reverse cycles. That may be the pause that will then see us go higher and possibly take out this level of resistance. So let me get rid of that here. If we do continue moving higher, we can identify a steeply rising cycle here. We know that the next level of resistance, if we were to break through this sideways resistance, is the rising level of resistance that's part of this rising cycle. So could be 2188. Depends on where we would hit that level of resistance. We are going to start to run into a pretty strong headwind if we go higher, because we've got a level of resistance that's reasonably close to where we're currently trading, and we would still have contention with the upper Bollinger Bands. And of course, we need to break above this strong long-term line of resistance, all of which could happen But I personally think that the higher we go, if we do, we're just going to continue to run into a stronger and stronger headwind, which is just then a matter of time before we get into a reasonable reverse cycle. Look back historically, folks, at the rising cycles followed by declining cycles, short-term rising cycles, longer-term declining cycles, and look at the time periods that each of them last. This one is starting to get on the outer reaches of our average, the median time period for a rising cycle. That doesn't, again, guarantee anything. The only guarantee I can provide to you is that there will be a declining cycle at some point. What I can't guarantee is when that's going to occur, and that's why I do this macro view of the charts, because I'm looking for hints and clues. If all of the technical indicators that I use align, all pointing to the same directional bias, well, then it's just a matter of being patient and waiting. But we always then set these charts aside and go back to our Able Trend charts, because they are going to give you the best, most immediate signals for taking an entry of a trade. And then, like Michael said, base hits is a great way to accumulate a significant amount of growth in your account rather than holding out for that one big home run. Home runs in general are not going to win the series. Base hits are going to win the series. So that's what we like to do, and it constantly recycles our capital. Something as small as $400 a day. So take Michael's trade, for example. We generally will trade one or two contracts on those. If he held two contracts of that just one trade, then he would have made about $400. $400 a day on an average can generate a $96,000 a year income if you average that over the course of each trading day over the course of the year. Now, you won't make $400 every single day, but some days you might make $1,000. Other days you might make nothing. Other days you might have losses. A $400 a day average is reasonable for even a smaller account size. We do advise that you have a $25,000 account to trade with. Of course, it's entirely up to you how much you actually want to trade with, have in your account. But $25,000 account is a very reasonable amount for you to be able to achieve that level of profit. So let's take a look at NDX. Now, NDX is the one that's just very fascinating to me because it's been very consistent with this declining channel. I mean, we've been tracking this declining channel for quite some time, and I've highlighted it in red so it's easy to see. And then within that declining channel, we have a slightly rising pattern that's coming across this set of highs here, and then it's capturing the most recent highs of yesterday and today. So yesterday the high was 46.04. Today the high is 46.07. So we hit we hit a new high, not a new all-time high on NDX like SPX, but we hit a new high in this range of rising pattern. And what that means, the significance of that is the bearish divergence. We're right now trading near the bottom of today's range. We have 3.5 hours before the market closes, so it's way too premature to tell. But if we did finish in the bottom half of today's range, it would be a bearish divergent bar occurring at a long-term line of declining resistance and coming off of a 2-day pattern of stalling at that line of resistance. We had a bearish divergent bar 2 days ago. We did not have one yesterday. Let's take a look at the 30-minute time period and look at the AO. Same story, different index. There's consistency in what we're seeing here across the three indexes, which is another factor, in my opinion, for pointing to a certain direction. All three of the indexes are showing weak momentum. All three of the indexes are showing trading activity that has stalled at or around a long-term line of resistance. And two of the three indexes, SPX and NDX, are at least as of right now subject to change and validation later today, but they're forming bearish divergent bars today. All of those things are strong indicative clues that we could potentially see a move to the downside. Look at this declining Twin Peaks pattern. There's practically no momentum in NDX, but during that same period of time, we did see pretty strong rising price. So if I take the studies off again, and we look at where we could possibly trade down to if we did trade lower, and I'm just kind of arbitrarily going out to my line of support and picking a point in time, what we could see is trading back down to 45.50-ish range. 45.50 would be the first level of support, and that's after we either flare out the Bollinger Bands or press below the Bollinger Bands. Next level of support might be around 44.90 range. And then, of course, we have a longer term line of support that is down around just under 4,200. Is it unreasonable to expect that perhaps NDX could trade back down around that 4,200 range? I would say not at all. We traded around that range at a low of 41.79 actually on the 27th of June, and we've been in this rising pattern since. One other way I could determine where we could potentially trade down to, I'm going to go back to the 1-year daily, make this very simple, and I'm going to put a Fibonacci retracement grid from that low on the 27th to today's high, and a 38% retracement, which would be a reasonable retracement before resuming the rising pattern. Could take us down to the 44, 43 range. 50% retracement could take us down to the 43.93 range, and a 62% retracement could potentially take us down to the 43.40-ish range. So we're talking about a retracement that may only be a pause, a breather in an otherwise rising pattern. If that's the way it played out, that retracement could take us down 150 points. Well, that's a huge opportunity in the type of trading we're doing, whether you're legging into a spread or whether you're day trading. That right there is a lot of opportunity that's going to occur. If a move like that did occur, it would be very, very unusual that it would occur all at one time. So what you would have is a cycle that is moving lower, and there would be movements higher and lower within that cycle. And that's exactly why you want to pay attention to the Able Trend charts, the short-term time periods, because those charts are going to give you the signals and the entries when it's opportune to get into a trade. So macro view based on the bar charts is telling us what could potentially happen without any certainty or guarantee. Able Trend charts are telling us now is the time to get into the trade. Use and apply your macro view to understand whether you want to be more conservative or more aggressive and what the likelihood is of it playing out. Michael also mentioned that sometimes if we're in a trend, he might hold a little longer for just that single base hit. That's okay too. If you see a signal to go short on NDX and you know that we have the potential even of just coming back down to 38% retracement, you might want to hold longer. Generally, we don't do that. Generally, we don't stay in the position very long. It almost doesn't matter to me what the trend is. If I've harvested a nice profit and I can then take my capital and sit on the sidelines and wait for the next entry opportunity, that is my preferred method of trading because I can guarantee that profit when I close the trade. If I have a profit of say $2 or $3 in the trade and I'm going to hold out for more, well, that $2 or $3 of profit may evaporate and then it may materialize again and then may give me more or not. So what I'd rather do is to take the $2 to $3 of profit if I'm day trading, or lock in my trade and leg into a spread and then look for the next opportunity to get in again and take another $2 to $3 of profit. That's the whole base hit philosophy that we're talking about here. But for me personally, and I'm just going to conclude here, What I really enjoy and what I get passionate about when it comes to charting is following these patterns, looking for the clues, and then looking for validation. So I don't know for sure that we're going to stall at a certain line of resistance that I've previously identified. But when we come up to that line of resistance and we trade there for 2 days and then start trading lower, that to me is providing some validation that perhaps we have in fact identified our resistance appropriately and perhaps we will move lower. I can't guarantee anything beyond what I see, but I love the art of interpreting the charts, looking for those clues, looking at all the different factors, how many of them align to the same directional bias, and if they do, then it just gives me a greater degree of confidence in taking a new trade and looking and enjoying, looking for and enjoying the profits that I can take on that. So, Michael, can we just jump back one last time to your Able Trend charts? And I just want to share with
Sure.
people the red waterfall that seems to be occurring on
Sure.
all the time periods here.
There you go.
So,
I, I'll,
go ahead, Michael.
I'll find just really quick. This is interesting. So here's the 30-minute chart. You're getting a sell signal on a 30-minute chart. So we'll see if that's valid or not. So that's the first, the first sign is the 3-minute. Then the 30 is going to come. Then the 60 will come, and then the daily will finally come if we're really going to trend down. So
Michael,
I find that
why do you say we have to wait to see whether or not that's valid? What is it that makes you
the
question that?
this is a 30-minute, 90-minute chart. This is a 30-minute bar sell signal. This is 90-minute support. So I need to make sure that 90-minute support is not going to print again at 1:30 today
Yes.
because
Okay.
started well. That's what I'm waiting on. And the SPX is identical, absolutely identical. You can see that right there. So that's a good sign. I think that we could possibly go lower.
And we're trading on SPX. It looks like we're trading right at that level of support. So
Yes,
this is a critical point for us, especially if you want to be an ultra conservative trader. Once you see confirmation of that 90-minute support no longer printing, then you almost have an open door to say, listen, we're most likely headed lower.
yes,
The other thing I wanted to point out is when we started with your charts here a few moments ago, NDX and SPX were very consistent, not only between their two different time periods, but between the two indexes. But RUT was not consistent. It's kind of an outlier. But look at what's happened now in the last few minutes on the 3-9-minute RUT. We're stair step lower, we'll double stack to the downside. So all of a sudden it's gotten in sync with the other two indexes.
yes,
The only one consideration, exactly what Michael's highlighting there, is of those 6 charts, the only one that's not consistent is the 515 on RUT because we still have a level of support, 15-minute support. But once that 15-minute support stops printing, what we have is kind of the perfect scenario that we look for. We would have 3 indexes that are all aligned, all showing the same thing, all double stacked to the downside, and both time periods on all 3 indexes are aligned. That alignment, in my opinion, is gold for being able to take profits, enter positions and take profits. Yesterday, when we were showing these, the time periods were inconsistent, the indexes were inconsistent, and it was a great day to sit on the sidelines and really not do very much, which can all by itself be a little frustrating for someone who has a desire to be an active trader. But I'd like to be actively taking profits, and if I don't see consistency amongst my um, indexes and my technical signals, then I'd like to be actively sitting on the sidelines protecting my capital. That's the way I look at being active as a trader. Michael, any last thoughts about today's trading in the live trading room?
no, I'm good, Mark. I think we're just looks like we're trying to sell off. That's pretty obvious right now. So let's look at the charts. All of them are to the downside, and the 30-minute, 90-minute chart really makes me think that we could be making a turning point here and heading a little bit lower, and pretty excited about that.
Can you be successful following these signals if you just trade one contract?
Absolutely. Just think about it, Mark. Now, while you were talking, and I'm not going to blame you for me missing all these trades, but no, seriously,
You didn't have
I
your
get it.
assistant on that opening those trades?
Yeah, no, well, that's another problem I have to deal with later. But no, anyway, but you can see I got in here, and of course I made my profit. It pulled right back up again the sweet spot.
Mhm.
There was that close bar again. Got in there, pull back up the sweet spot, closed at the bottom, and look what happened again. So there's three in a row that
Three trades.
worked.
In how long a time period was that?
Oh, it started at 11:36, and now it's well 12:39. It's almost a little over hour and change, hour and
So,
3 minutes.
so three potential trades, one contract
Mhm.
trades. Each of
Yes.
those, let's just be conservative and say maybe each of those you would have jumped out of for $1.50 a profit.
Yeah.
So you've got $4.50 of potential profit if you've taken all three of those trades. And on one contract, that's $450.
That's right.
So, like I said before, if you can average $400 a day, you're going to have some days where you don't make anything, some days you're going to lose, and other days where you're going to make far more. But one
Yes.
contract is the right way for you to start trading. I I find that a lot of option traders come to trading with a limited understanding that they think is an advanced understanding because they read a whole bunch of books and attended a seminar. But they then start trading 5, 10 contracts because they think that that's conservative. And they think that they start inventing all sorts of limitations for themselves. And one of those limitations that they invent in their mind is that the transaction costs are just going to kill me. I hear that expression all the time. That's just not even close to being true. Um, uh, we factor our transaction costs in and still average more than $400 a day. And if you can
Yeah.
net more than $400 a day after your transaction costs, one contract trades are going to allow you to sleep peacefully at night.
Yes. You know, Mark, you brought up something I think that I have to share it with you. And Mark always cringes when he thinks I'm going to say something because he never knows what's going to come out of my mouth. But anyway, think about it for a minute. You know, I know you charge me $5,000 a month to be in the live trading room, but I think
Don't
everybody
say
else,
that. Nobody, and everybody
no,
will
there's a
think
lot.
you're not joking.
I'm joking, folks. But I've been trading a long, long time. It helps me to be in the live trading room just to interact with other clients that we have. I mean, they're just lighting my board up now, say, hey, I just made $2 on this move down. I made $1.50 on this move. I just legged into this trade. I mean, it happens every day. And for what little the trading room costs, I mean, you make up your one trade, you can make back what the monthly cost of the live trading room is. I mean, it's with one contract. If you basically
Yeah, the live
help
the
me
live
out, Mark,
trading room
because
is
you know what I'm saying.
$295 a month. You can, like Michael said, you can make that back in one single trade, and then the rest of the month is all upside to you.
But Mark, yeah, I'm sorry, and I got this thought. I'll forget it. I apologize. That's my spiritual habit. But anyway, yesterday we had a couple of guys. We were talking back and forth in the room. He said, "Thank you for not letting us get in that trade today." Well, it wasn't me. They could have done what they wanted to. I was just saying I wouldn't take this trade. Here's why I wouldn't take it. Then sometimes they'll say, "Hey, Mike, look at the chart. What do you think about that?" Oh man, that's a great trade, and we all do it together,
Mhm.
and it just makes it more. It makes it easier for me to trade. It makes it more. I have more confidence because if everybody else sees the same thing I see, or I see something that's going to keep me out of a trade, and I share it in the room, then they don't follow along, and like yesterday, we'd have got beat up pretty bad yesterday. Would have went in, no doubt. I mean, that several people told me that in the room yesterday, and including myself. I know we would have. So for $295 a month, oh my gosh, it's just I don't know. It's an
Well,
insurance policy for me.
trading, if you trade as a business, which every single trader should think about their trading as a business. It can be a very lonely business if you're isolated by yourself in front of a computer um, and you don't have anybody else to interact with. So the live trading room provides an opportunity to be part of a community of traders who are all having the same goal and the same desire to learn and be successful. And they don't have to take each other's trades. They don't take all of our trades. All we're doing is trading and sharing our thought process behind each trade. And for me, I'm like you, Michael. I love reading the comments from people in the room and the trades that they took and the profits that they took and how they legged into this trade or they did that one as a day trade. And when they're pointing out certain things on the charts, it tells me that they're learning and they're thinking like a trader, which is one of our goals, is to teach people to think like a trader. But
Yes.
you're right, there are a lot of things to look at if you want to take in as much data as possible. And sometimes our traders in the live trading room will point out something that maybe we hadn't seen yet. And I appreciate that. That's just being part of a trading community. It's a lot more fun to trade
Yes.
that way.
Yes.
All right. Well, thanks for being here, Michael. Thank you, everyone,
No
for
problem.
being part of the live trading room. And I hope this is helpful to you. We look forward to providing you an overview. I love doing the analysis and just getting a broad perspective of where we might be headed. Right now, my view is looks like we want to head lower. And even that last 5 minute, 15-minute RUT chart is showing that we're breaking below that 15-minute support. So looks to me like we've got all of our time periods are consistent. So have a great weekend, everybody, and enjoy your trading the rest of today.